Hello, we're Group 7. My name is Zehui. Today I'm going to talk about the first part of our presentation. We conducted a comprehensive analysis of Woodside Petroleum Limited using historical data in the past 10 years to analyze its financial situation, such as financial ratio analysis, performance forecast, industry analysis, and risk analysis, and also used asset valuation, WACC, discounted cash flow module, and Olsen module to derive the final valuation. And now, let me briefly introduce this company. WPL was established in 1954 and is located in Perth, Australia. It is the largest independent oil exploration and product company in Australia, mainly engaged in the exploration of natural gas, oil, and the related development project. And next, we used the 5 force framework to analyze the competitiveness of WPL. The 5 force framework refers to the threats of new entrants, the bargaining power of buyers and suppliers, the threats of alternative products and services, and existing competitors. We believe that the intensity of rivalry, threats of new substitutes, and the bargaining power of customers are high. The competition among existing players in the energy industry is fair, and the price competition is prone to occur, which will drive down price and reduce the profitability of the entire industry. WPL is engaged in the energy industry, and its investment include asset and equipment investment with high exit barriers. Meanwhile, there are many alternatives from customers to choose from. Industry products are standardized, and buyers face extremely low switching costs when changing suppliers, so customers has high bargaining power. Bargaining power of supplier is medium. In this industry, the income of supplier group does not depend heavily on the industry, but the product provided by the suppliers are similar, and there is no obvious difference. Threat of new entrants is low. This industry requires proprietary technical equipment and high entry barriers brought by large capital, so we saw that the threat of new entrants is low. That's all of my part, and next part will be introduced by my group members. Thank you very much.
Okay, this is Inoja from Group 7, and let's move to identify key accounting policies. As just mentioned by Zehui, according to Porter's 5 forces framework for WPL indicate that the rivalry, threat of substitute, and bargaining power of customers is high, bargaining power of supplier is medium, and threat of new entrants is low. Woodside Petroleum Limited is an energy-based company. In the energy industry, although there's a high barrier for new entrants, however, customers are sensitive with the price due to the similar product among the providers and low switching cost. As a result, WPL is more likely to focus on cost leadership strategy by increasing the quality of the product, but in a relatively low charge. So, according to the research, Type 1 accounting policy is suitable for WPL's current marketing situation. In terms of accounting strategy, it describes a method that how a company evaluates its accounting data. As indicated in WPL's annual report, they are using the straight line method to calculate depreciation of buildings, plants and equipment, marine vessels, and carrier with a reasonable useful life of 5 to 50 years. And inventories are valued at a lower cost and net realizable value. Also, WPL's goodwill and goodwill impairment is presented at 0 all the time, so WPL's financial report will appear to have a greater revenue. As a result, both inventory recognition and goodwill impairment will lead WPL have an aggressive accounting policy. WPL's annual report is audited by EY. In terms of quality of disclosure in its income statement and balance sheet, investors can only get limited information. Also, in WPL's financial report, operating leases, research and development is not presented. However, there's still some extra information like external customers as well as detailed tax report, so they are considered as a moderate disclosure. WPL's asset turnover is between 0.15 and 0.31 from year 2011 and to 2020. This means each year WPL is able to use each dollar of asset to produce around 23 cents of revenue. WPL's fixed asset is between 0.21 and 0.42. Each year, WPL is able to use each dollar of its fixed asset to generate around 30 cents of revenue. Inventory turnover indicates the efficiency of a company to convert its inventory into cash. As you can see for WPL, its inventory turnover was increasing steadily in 10 years. This shows WPL have an ability to sell its inventories in a short period of time. And move to liquidity and solvency ratios. WPL's current ratio is around 2 for most of the time. This means WPL have enough current asset to cover its current liabilities. However, when we move to debt to asset ratio, according to the annual report, its debt to asset ratio have a range between 30% to 50%. This appears lower than industry average. This indicates WPL might not use the leverage well. In terms of profitability, all the profitability ratios are appearing to have relatively stable trend only except year 2015 and year 2019. In 2015, operating profit margin, net profit margin, and gross profit margin all showing a downward movement, but bounced back in next year. However, in 2019, WPL had an even more severe decline in profitability. Operating profit margin, net profit margin, and return on equity all dropped below zero. Dew-point analysis is a method that is used to analyze the component of a firm's return on equity. It allows an investor to determine what financial activities are contributing to the most changes in ROE by breaking down ROE into 3 joining elements. So company managers were able to compare the operational efficiency with other same industry competitors. As you can see in this page, return on equity and return on asset tend to have a similar trend. However, financial leverage ratio seems to have a different fluctuation with ROE and ROA. As a result, the change of ROE is related with ROA. Now let's look at the relationship between ROA, net profit margin, and total asset turnover. In year 2015, ROA is increasing, but total asset turnover is having a downward trend, so net profit margin is an important contribution of ROA. And move to net profit margin. Look at the trend over the 10 years. Only gross profit margin have a similar fluctuation with the net profit margin. So gross profit margin is the determination for the net profit margin. Finally, the key factor to change the ROE is gross profit margin. In terms of Altman's risk assessment models, it is an evaluation based on 5 financial ratios. By putting these 5 ratios into a formula, it will suggest investors whether this company will survive or bankrupt. In Altman's model 1968 version, WPL is not doing well financially in year 2011 and 2012. The result of Altman's model is bankrupt. After year 2012, the situation is getting better. In year 2013, they are in gray, and after 2013 until 2020, the results are always survive. However, in 1983 version, the situation become different. As you can see in the second table, from year 2011 to 2018, WPL's operating contribution is gray, but in year 2020 and 2019, it shows as fail. The reason why WPL have such different result in Altman's model between 1968 version and 1983 version is because the contribution is different. In version 1983, the contribution of X1 dropped from 1.2 to 0.717, and X2 dropped from 1.4 to 0.847, as well as other elements. So it is obvious that Altman's model 1983 version have a higher requirement for companies' financial activities.
This part will focus on financial forecasting. Financial forecasting refers to the process used by companies to predict future income, expenses, and cash flow. It helps companies demand future revenues and expenditure trends that may affect strategic goals. An accurate forecast helps to make the right decision. The first step, as shown in this table, is to select the project values of the key financial ratios. In Excel, those possible values are calculated include the average of all year, last year, average of the last 2 years, average of the last 3 years, median of all year and their equation. Then the appropriate value is selected. The second step is to forecast WPL's projected earnings, balance sheet, and cash flow. Based on the financial projections, NPAT is expected to grow slowly but steadily in the coming years. This also indicates that the company will be able to continue to effectively generate profits for its investors. In addition, the company's net assets have continued to grow over the past decade and are also expected to increase as total assets grew faster than total liabilities. However, it is estimated that WPL will invest heavily in excess in 2020, and the free cash flow is expected to decline significantly. However, dividend payout continue to trend steadily upward. Overall, WPL is expected to be in a strong financial position over the next 10 years. The next part is estimated cost of capital. The cost of equity is the return required. CAPM is used to calculate the cost of equity based on risk-free rate of 13.93%, beta of 1.358, and the market rate premium of 6%. The estimated cost of equity is derived as 9.54%. The cost of debt is the effective interest rate a company pays for its debt, such as bonds. This table shows the cost of debt for WPL. What can be seen is that the cost of debt is negative. WACC is a calculation of a company's cost of capital. By calculating the WACC, it helps determine the feasibility of an investment. A company's WACC increases as beta, and the return on equity increase. As shown in table, market value of debt, market value of equity, and the market value of the firm are derived from the market and the book value of the equity. The two valuations obtained are 5.65% and 4.89% respectively. We use 5.65% as the WACC.
This part is for valuation models and results. There are 5 models: dividend discount model, discounted cash flow model, price earnings and price to book ratio, residual earnings model, Olsen's earnings and book value model. The first model is the dividend discount model. As shown in the figure, we have 4 kinds of hypotheses to derive 4 kinds of predicted stock prices. Through analysis, it's found that the DDN model has some shortcomings. For example, when a company's rate of return is lower than the dividend growth rate, the DDN model will fail. second model is discounted cash flow model. Light estimates the value of an investment based on expected future cash flows. Through the two valuation methods of DCF, it found that the DCF model is very sensitive to future cash flow. Without the correct cash flow, the DCF model is inaccurate for investors. The third model is the price-to-earnings ratio and the price-to-book ratio. Through Light, we use valuation formulas to value WPLO's stock price. It can be seen from the data that the median and the mean value of PE and PB are the same. There is no comparison. The fourth model is the residual earning model. After use Light, the value of per share is $23.72. If used another valuation models together, residual earning model can allow investors to estimate the true intrinsic value of the company more clearly. The last model is Olsen's model. Like the value of a company consists of two main parts, book value and return. In using Olsen's model, determined values are based on long-run PE and WACC. In the end, Olsen's valuation was $30 and $34.45 respectively. It's found that Olsen's model has a more coherent theoretical framework and a more complete analysis of profitability. There is a summary of WPLO's equity valuation. In conclusion, the Porter's five forces indicated that vendors pose a little threat to WPLO. Therefore, WPLO should continue to maintain the supply price and use a cost-first strategy. From the perspective of WPLO's accounting strategy, both inventory recognition and goodwill impairment will cause WPLO to adopt active accounting policies. WPLO's financial ratios indicate that WPLO's profitability has declined since 2019, but the current ratio is normal and there is sufficient liquidity to cover current liabilities. Two-bond analysis shows that the key factor for WPLO to change ROE is gross profit margin. Altman's model 1983 shows that from 2013 to 2020, the result is always survival. Altman's model indicates that 2019 to 2020 will be displayed as fail. This model has higher requirements on the company's financial performance. According to WPLO's financial forecast, WPLO expects to maintain a strong financial position in the next 10 years. Based on the summary of WPLO's equity valuation, we recommend that investors can hold WPLO's stocks. Thank you for listening.